Welcome to the Cardinal Commentary for the Canadian Equity Portfolios. The first quarter can be summed up in one word: tariffs. As U.S. President Donald Trump announces, then pauses, then re-announces tariffs against its closest trading partners, it's virtually impossible to predict where the markets, or anything else for that matter, will go. These are most definitely unprecedented times. It's not just Canada and Mexico in Trump's crosshairs. On what he called Liberation Day, he imposed tariffs on about 90 nations around the world. They include Cambodia at 49%, Vietnam at 46%, and even Switzerland at 31%. Incredibly, the Hart and McDonald Islands near Antarctica, which are uninhabited by humans but home to penguins, have been slapped with a 10% tariff. Penguin memes immediately flooded the internet, and the Guardian newspaper in England ran a headline: "Penguins, pay up." Despite all of this, we think a global trade war is so illogical and would be so unpopular that it simply won't happen. But it's not all doom and gloom. In fact, we believe the international trade machine is simply too difficult to stop. For example, computers, phones, and batteries are the top imports to the US, and there isn't nearly enough excess capacity to replace these goods that are most definitely necessities. Portfolio manager Terry Wong says one positive result from the trade war is Canada and other countries are likely to form trading partnerships to reduce their dependency on the US.
The one thing that will probably come out of this is that the countries around the world will have a better relations in terms of exporting, importing goods, Xing out the US, obviously, because that's been more of a hostile environment from a tariff situation. And with that does create an opportunity for Canada to expand its global trade network. And I think that will be better for consumers and businesses alike.
Our investment team has researched the potential impact of tariffs on all of our companies, and we believe that we are well positioned to combat this threat. It's virtually impossible to dodge the tariffs completely, but two of our companies, label maker CCL Industries and Element Fleet Management, a provider of automotive fleet services, are close. Equity analyst David Amy says another holding, Gildan Activewear, has a long history of navigating uncertain times and emerging in a much stronger position.
They entered the current environment in a good financial position with a strong balance sheet, and their low-cost manufacturing has allowed them to sell their product at a lower price to customers and allow them to take market share. The tariffs are an interesting situation for Gildan. Most of their manufacturing is in Honduras, so Honduras actually has a trade surplus with the US. So most of the tariffs have been targeted at Southeast Asian countries, where a lot of Gildan's peers have manufacturing. So ultimately, while it does impact everyone, it could be a positive for Gildan.
10 of our companies increased their dividends in the quarter, led by Boardwalk REIT and Brookfield Corp at 12.5% each, followed closely by CCL Industries, Gildan Activewear, and Manulife Financial. Despite the unprecedented volatility around the globe, our Canadian portfolios continue to outperform when it really matters, like over 25 years. And here's the proof. If you had invested $500,000 in our Canadian equity portfolios in 1993, it would be worth almost $12 million today, outstripping the benchmark by nearly $5 million. And all of this demonstrates our commitment to clients, a common sense path to long-term wealth, because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.